Hi, my name is Amy. Thank you very much for watching, and let's make some amazing financial commentary together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I would really appreciate that. So today I was on X and I saw that this was trending, and it says skip emergency fund after $200,000 in your brokerage account. And I am close to $200,000 in my brokerage account if you count my margin. I usually just say I have $80,000 of equity in my account. I don't really count my margin as the total usually, but in this case, I am commanding around $200,000, and I have not had an emergency fund since 2023 because I had a financial emergency, and I have basically backed myself into doing these high income ETFs. And so my opinion of this is I don't think you need an emergency fund in general, but if you don't have an emergency fund, having high income ETFs is a good thing. That way you're just always getting enough money, working towards your portfolio, just producing enough money every single month to, generate enough income so that you can pay your minimum monthly expenses just ongoing. And what do I mean by that? Well, this is a pretty conservative portfolio with CSHI, which is treasury yields, and a little bit of options income on the S&P 500. Then you have week, which is 1 to 3 month treasury mills, usually pays like a 3% distribution. Then you have HCOW, which are cash flow positive companies. This is equity, but it is stocks. But in my experience with having owned this, when the market goes down, like the S&P 500 goes down, these go down less usually. And if it's an AI tech sort of a correction, HCOW won't go down as much. It doesn't go up as much, but these are the sort of companies that are pretty stable and they have high free cash flow. And then 5% of an inverse with YQQQ. And so with this, you're getting 8.5% yield, which is $1,400 a month. And so what I'm trying to get at with this is you don't have to be in high income ETFs if you have a $200,000 portfolio. However, if you do have a $200,000 portfolio, you should go through the mental exercise of what would I do if I had my job loss, if I lost my income. Would I be going into high income ETFs? Would I be selling my portfolio? Would I be getting margin and using margin loans to pay my expenses? Or you could even get into doing options, doing put credit spreads or call credit spreads or both on the S&P 500. With $200,000, you could safely do about 5 to 10% of your portfolio in these options and just kind of produce enough money for you to live on. That's always an option. And so I also wanted to point out this is a more aggressive portfolio where it's basically half in Oval, half in TDAC. Oval is an S&P 500 fund that pays around a 10% yield. TDAC is a NASDAQ 100 fund that pays around 17%, and then SLTY, which is 70%. And this gives you a 15% yield. And so that's $2,600 a month with $200,000. And this is yieldmite.com. I'm the owner of it, and I do receive revenue from this website, but this video is not sponsored. But all you do on Yieldmite is you go here and you can build a portfolio and you can mess around and see with the combination of everything that I have and the percentage I have of everything, what is the yield I would get from this portfolio. And then I used testful.io, and this is doing the conservative portfolio of 25% in CSHI, 25% in week, 45% in HCOW, and 5% in YQQQ. And so you can see, and this is total return and price return. And TLTW is the benchmark that we're using. So TLTW, with no dividends reinvested, you would have had 9,132 for basically 1.5 years. But with this conservative portfolio, you would have had $10,206 if you did not reinvest any of it, and $11,561 if you had reinvested everything. So I think that once you do get to $200,000, if you have an emergency fund, the dip becomes the emergency. So if the NASDAQ 100, we get into correction territory, that would be a really great time to buy good companies on a discount. And that's what your cash is for, because if you are just in growth stocks and then the market goes down, you don't necessarily have the cash to deploy to take advantage of the situation. And you could go into like treasury bills and cash alternatives that don't drag on your cash. But I understand the issue that this X debate is bringing up, where people want to have that 3, 6, 9, 12-month emergency fund in cash so that they don't have to worry about anything. But having it in cash, even in a high-yield savings account, that's not necessarily beating inflation. And you can't save your way to wealth. So you would definitely be better off having it invested. But the drawback of having it invested is that what if the market really turns on you? And, it's just a different risk profile than some people are comfortable with. So for me, and this is the market beat, and if you didn't drip, you had $200,000, you were earning an 8% yield, it was going up 1% per year, then at the end of 20 years, you would have $244,000. Your total return would be 22%, and your annual dividend would be $16,489. But if you dripped everything, then you would have had $1,029,773.03. Your total return would have been $414.89. Your annual dividend income at the end of 20 years would be almost $70,000. And so this is what people mean by you don't necessarily have to have a Hail Mary. This is just $200,000 and not contributing anything and having a high dividend yield with a low price appreciation, which I got that price appreciation from the CAGR here. So we're at 1.4. So if it only appreciates 1% per year and you don't have big drawdowns because you're in conservative things, but you do have a relatively high dividend yield and you're reinvesting it when you don't need it, then it's possible at the end of 20 years you would be pretty happy with how that portfolio grew. So I just think it's worth exploring your options about what you would do in a situation. If you have $200,000, would you take out a 0% interest credit card and then produce money either through high income ETFs or doing your own options to pay off that credit card? Like, these are legitimate things. Once you have money, you have way more options in order to deploy the money. But I do think it's better to have some income generating things in your portfolio, because when the market goes down, and it will go down at some point, it would be great to have some kind of dry powder, as they call it, of I need money to buy this dip to get into these stocks at a good price. So having an amount set aside, whether it's in something like WEEK or CSHI or in actual treasury bills or in a high yield savings account, whatever it is. And there are credit unions that if you use their debit card like 7 times in the month, you can have a relatively high interest rate. Like, I haven't done it, but back in the day, it was like a 10% yield in your cash. If you can get, 5, 6, 7% in cash, and all you have to do is use your debit card 7 times for the credit union, that might be a good place to set your cash that you're going to use during a dip, so that, when you get those at the good price, it compounds, and then, at the end of 10 and 20, 30 years, you have more money than if you did not have your dry powder. So I think it's really a thought exercise about how you're preparing for an emergency. And like, what do you plan on doing? Do you plan on using your margin? Do you have your high income ETFs so that you can pay whatever in full? Do you take out 0% credit cards and deal with it a little bit later? The answer is personal to you. It is personal finance and your own risk tolerance. You can still have, $10,000 set aside, or 3 months or 6 months. It depends on how specialized is your field of work. Like, is it going to take you 3 months to find a new job if you need a job? Or is it going to take you a year and a half? Who knows? So, anyways, but to me, if I had $200,000 in equity, and then I used margin, and I was in these lower beta high income ETFs, I could have like $500,000 worth of investments and with the margin, and I would just live off of that, just get the income that I need in perpetuity, and continue investing in growth stocks as I can. But to each their own. Anyways, my question for you is, when you reach $200,000, do you think that you'll have an emergency fund? And I'll talk to you later. Bye.